Got a question the other day or a comment the other day that said, Josh, your recent videos make me believe that you're becoming a bear, i.e. negative on the markets. And the answer to that is unequivocally no, not a bear in the least, not a bear in the least. I am as long as we have a semblance of capitalism, I will forever be a bull on stock investing. I'm absolutely a bear on bonds, as I've stated many, many times for sure. Real estate concerns me. I'm not going to lie to you. Real estate concerns me. But the biggest thing I'm a bear on is debt, especially debt to finance things like a big home that you probably can't afford. So the answer, I'm not a bear. I do think we have to look at the current situation, though, and you got to think, what if? We don't have a handle at all. As much as we want to, think the Fed has all this control and they're the holy grail. They can pull anything in the strings and we'll all be good. When have they ever done that? I mean, the Great Depression. In fact, here's a great book you got to get: "The Failure of the New Economics: An Analysis of the Keynesian Fallacies" by Henry Hazlitt and Murray Rothbard. Murray Rothbard also has a book on the Great Depression, which I have back there. I just can't find it. So anyway, if you're looking for a more anti-establishment method of looking at the Great Depression, it can be tough to beat Murray Rothbard. The reason Ben Bernanke became the Fed Treasury chair is simply because he had written extensive work on the Great Depression. And he did understand what caused it. What caused it was a contraction of the monetary supply. It wasn't the Smoot-Hawley Trade Act, which a lot of people on the free market would say. It wasn't the stock market decline, which a lot of the left would say. Both those things contributed absolutely, but it's actually a contraction of the monetary supply. And when monetary supply is contracting and people need money in which to go about their day-to-day lives, is inherently deflationary, and that was bad. That happened under the guidance of the Fed, though. I mean, that happened. But Josh, how about the boom bust in the 1800s? All right, well, we had boom bust in the 1800s before the Fed. Now we got boom bust in the 20th century with the Fed, and even into the 21st century. So has the Fed absolutely solved that? No. In fact, if anything, they made it worse in terms of the level of violence that happens because people think the Fed can rescue us, and they just can't. So the Great Depression, we know, is a contraction of the monetary supply. And the Keynesian argument would be we needed to spend more money. And that was inherently right. They were right in that regard. They were not right in 2008 and 9, though, for sure. And we'll go into that here in just a second. But so when you have a contraction of the monetary supply and is putting the reins on people's ability for liquidity and capital, well, the one thing you don't want to do is keep the monetary supply from expanding. You want to grow the balance sheet of the Federal Reserve. You want to have government spending for sure. I mean, these things are pretty natural when it comes to basic economics. No one would sit there and say, from an Austrian perspective or a monetarist perspective, that, oh my goodness, we're violating our free market principles. No, I mean, the reason the Great Depression was exasperated was actually FDR's insanity legislative stuff, his executive stuff, which is just nuts. I mean, plowing over fields of corn when people are having a hard time finding work and finding food. It's insane. Making it illegal to own a dollar, incorporating that I can't go and hire my labor for what I want. I'm willing to receive a price for it in terms of minimum wage and whatnot. I mean, all this stuff. NRA, not the National Rifle Association, the National Recovery Act. This was just nuts, man, nuts. You just got to look at the history of the Great Depression and recognize the government and the regulating agencies, including the Fed, really worked to exasperate it. In some cities, there was 50% unemployment. Nuts. FDR did not solve that. It just did not. So, government spending helped. Not going to lie to you, it helped, but his rules and regulations overrode the government spending for sure. And it's just, I don't want to say it's not debatable, but Bernanke, he rose to power under the idea for sure. Now, the problem that we had in 2008 was just, again, we had a contraction, essentially, not of the monetary supply. In some ways we did, though, because just going back to my man Joe, and myself included, I did an email on this the other day. I said, look, they were regulating people who were performing on their loans to come up with capital they did not have. And they did it through things like mark-to-market accounting. They did it through things like the regulators telling the bank we need to increase our capital. And all that did was exasperate the Great Recession because they're sitting there thinking, okay, Mark-to-market accounting says we have to maintain a certain level of equity to our asset. It's no different than a loan to value. It's not debt to income, but a loan to value. When the value of these properties fell for whatever reason, and real estate falls simply because it's highly leveraged. It goes up and down for sure. People are losing their jobs and stuff. They can afford it. So that's a normal boom and bust of any kind of market economy. To avoid that is to go where there are no boom and busts. We're all poor at all times. Socialism, we can't have that. And so we're going to get boom and bust. There's just no other way around. It's speculation, man. I mean, part of the reason capitalism works so well is because entrepreneurs speculate on where they think they can make the most bang for their buck. A lot of times they're wrong, but sometimes they're right. And when they're right, it increases all rising economy lifts all boats. So that's just how it works. That's how it works. And to avoid that, the boom and bust of the business cycle would be to say we're going to eliminate the opportunity for speculation and speculators to make huge amounts of money, but also take enormous risk, which could lead to a bust. We're going to eliminate that. And so there's no incentive at all for speculation, risk taking. That's why socialism can never work, because there's a command and control. It says, we see, we're the government. We see where the opportunity lay. We're going to assign, what should be done with the net gross product of the America and stuff. And it's just nuts. I mean, don't forget, the guy who ran the patent office in like 1890 says everything that's been discovered has already been discovered. I mean, this is how insane this stuff is, man. Look, it's easy to, in hindsight, to laugh at this guy, but this is the government regulation. They don't know, and they have no incentive to understand. And yet there's some freaking redneck engineer in his garage over there tinkering with, I don't know, freaking batteries to store electricity. It's nuts. Anyway, so what happened during here's a guy, Joe, who's running, significant car washes, making big bank, paying his loans on time. And the regulation says, oh, no, the value of your assets, bank, we'll just say, I don't know, freaking Bank of America has dropped because of the recession, or at least because of partly of the bust. And yet your loans outstanding are still here. We need you to be better capitalized. So you're sitting right here. The value of your asset has dropped because of whatever, just the business cycle. But yet your loans outstanding here, we need to get this back in flux in terms of mark to market. We're going to mark to market. The market price has dropped. We got to mark your equity to the market. And so what do? We tell Joe we need to raise capital. Joe's like, I don't have any capital. I mean, I'm wanting a cash flow business. I got tons of cash flow, but I don't have just $250,000 to give to you to get my capital up to what you're marketing. Your marking is my asset value. In fact, your asset value being marked this low is silly. It's a temporary stopgap. It's a temporary blip because the market will come back around. I mean, these things happen. Assets don't just stay stable. They go up and down. That's the lesson to be learned of the Great Recession. And when they go down, it's insane to force people to raise capital to keep a certain level of debt to equity. That's dumb. But that's what they did. And so now Joe's got to sell all kinds of stuff to raise the equity in order to get to what the mark to market. And Joe says, there's no buyers out there because the buyers got to get loans in order to pay for me. And I don't have any buyers. I don't have the money. So and you see this. So now because there's no buyers and now there's a bunch of demand supply, just like I talked about yesterday, the market keeps dropping because there's no buyers. There's no buyers, i.e. there's no demand. But the supply is being hammered. So tons of supply, no demand, no buyers. Inherently, the value of these assets are going to drop. The more it drops, the more mark-to-market accounting says you got to get it in flux you have to have enough equity to equal the debt level. It's crazy. It's crazy. This is exactly what happened. So now Joe plus Tim over there got to sell stuff at a huge price because they got to drop the price. I mean, to sell their stuff because there is no other side of the trade. There's no buyer. And so now that when there's no buyer and huge supply, the value keeps dropping and dropping and dropping, which means they got to raise more and more capital, and yet the debt levels stay the same. And the Fed, for all their stuff about quantitative easing, flooding the economy with cash, it doesn't do any good if there's not another side of the trade. You have to have two sides. You have to have demand and you have to have supply. And so the Fed's like, we're supplying all this liquidity But the bank's like, I can't loan that out because I have to have a certain level of debt to equity, and the equity is just falling off a cliff. So the bank's flooded with cash, but they don't have any lenders. They only want to borrow because of stringent lending regulations in terms of we got to make sure we're not giving ninja loans. The cash flow is dropping through the floor because people are going bankrupt. So we have tons of liquidity from the Fed's perspective, but it's not filtering into the economy because there are no qualified people to borrow. And on top of that, you have this huge supply of things just being sent into the market to sell, and the banks got to keep calling. It's just the freaking thing is nuts, man. So all the quantitative easing in the world won't fix that. It won't. I mean, it could maybe arrest a little bit of it. No, because all it's going to do is just make it more and more violent unless they get rid of the regulations. And this is where FDR screwed up. The Great Depression, yes, a contraction of the monetary supply was horrible, absolutely horrible. But what did he do? Yeah, he raised taxes. He did increase spending, but he raised taxes, taking more money out of the monetary supply, making it less incentive for people to speculate, invest. It's just, oh my goodness. Again, so you have the Fed's policy, you have the government policy, the executive or the legislative policy kind of competing butt heads. And here you got the Fed trying to helicopter bend, trying to flood the market with money, and you got the competing legislative and executive rules and regulations saying that's great, you can freaking flood the banks all you want, but we're going to make it hard as hell for them to freaking loan the money. And there's on top of that, there is no borrowers. And so, I mean, this is the kind of stuff that happens all the time with the rules and the regulations and the Fed. None of these guys. It's almost like, remember before 9/11. I mean, Jamie Gorelick should never see the light of day in Washington D.C. again. But for some reason, I don't know what it is. I mean, she's just she's the golden child, I guess. But so they did create this Chinese wall between the FBI and CIA. In a lot of ways, I'm okay with that, frankly, just because the CIA, we know, is corrupt as all can be, and the FBI was corrupt as all can be. The head, not the average guy and lady in there, but there are some corrupt people in there, and thankfully they weren't able to coordinate as much as we want. But that's what happened. Is you had the FBI, you got the CIA button heads about who has the authority, and because of that they watched Muhammad Atta and his band of Saudi freaking terrorists slip through the cracks, and we know this. And that's part of the risk of a free society, is that the FBI and the CIA should not be working all that much in tandem. And so for some way, I don't blame Jamie Gorelick for that, but at the end of the day, she should still not be rewarded, that's for sure. But anyway, be it as it may. So we have an economy now that's sitting on just huge amounts of liquidity at the banks. Businesses have all kinds of cash. And there's just not inflation. There's tons and tons of liquidity, but you just don't have, you have a lot of worry out there. You got a lot of people going into retirement. You got a lot of houses and a lot of debt. And you just, in terms of housing debt and stuff like that, you got tons of wealth. But at the end of the day, that concerns me about inflation. It's just not going to happen. It's just not going to happen, because as much as there's liquidity out in the market with the banks, with the Fed, lowering interest rates, that doesn't do anything. There's just not that many willing borrowers, and especially if there's going to be a huge supply, like I was talking about yesterday. So, from a debt perspective, I'm absolutely a bear. From a debt perspective, 100% unequivocally, I am a bear on that. I think it could come bite in the bud sooner rather than later, for sure. That's scary. That does scare me. It does. It does scare me. It does scare me because if it happened quickly, I'd be doomed. I don't have enough. I got a little bit of equity in here for sure, but if I didn't get the money I'm making to pay my mortgage, and the markets aren't willing to refinance to all that stuff, and then the banks said, they will never do it on the first mortgage, but still, that could scare me, because my mortgage isn't cheap, that's for sure. So if cash flow stopped, that's the issue. If the cash flow stops, I'd be in a hurting place for sure. Now, this is why I have everything else in stocks, though, because I know bonds aren't going to perform. I know that. It's inherent, bonds won't perform. Net of taxes and inflation, you're losing money for sure. Your real estate is probably going to perform relative to the rate of inflation, which is pretty low. Pretty low. And I would absolutely advise you not to assume big inflated prices on your property for sure. Just because, again, as I talked about yesterday, the massive amount of supply is coming down the pike. And then on top of that, the only other game in town is stocks. And still, with that said, here's the issue that is interesting to me. Corporate balance sheets are pretty clean, pretty good, absolutely, unlike the Japanese in 1990. In America, the corporate balance sheets are pretty clean, relatively speaking. So that means, and they're making money, profits, they're making money, earnings growth year over year is good. Price to earnings ratios are relatively high, but relatively high to what? That's what you got to look at. A bond market that's just not doing anything, and it won't. And then real estate market that's way inflated, and it only has one, in my opinion, only has one place to go. Well, two is flat or down. It has no upside in that at all. So the only other game in town is stocks. And yet stocks are supported by a growing earnings growth year over year, supported by tons of cash flow that can, even if the earnings growth year over year slows down a little bit, they can still make their dividend payments with the cash they have on hand, with a reduction in their current debt as well. So the current ratios look good. Their debt to equity looks good. I mean, not every corporation out there for sure, but the stock market buying the businesses of America. That's the thing. The stock market, the stocks and the businesses are different. I get that. But the stock market is literally just buying the businesses of America. You go to Walmart. I got to go to Publix. Got to Walmart. I got to go to these places every day. You go to Costco. You go to, all these, Amazon. All these places. I'm on right here is Google, YouTube. All these places are the companies of America. For them to all of a sudden en masse just take a $20 trillion kaput just doesn't make sense. It doesn't. Even in the Great Depression, it did not make sense. They still were there. They still thrived, even with insanity of the regulation, with the contraction of the monetary supply. If you would have invested, you would still come out ahead 20 years later. So that's the issue. For me, I'm still completely a bear. If not anything, I'm even more bull. If nothing else, I'm even more bullish on the markets, because I hate to say it's the only game in town, but it's supported by solid economics, earnings growth year over year, lack of debt, cash on the hand. We still consume products. There's always going to be a consumption. There's always going to be a demand side for products and services, always. Now, if you're buying something that, car wash, and you're living in Seattle, well, your demand probably isn't there that much. But if you're buying, a thing that you need, boots, socks, food, roofing supplies, stuff like all that stuff will always be there. So I'm pretty a bull on stocks. I'm a bear on these other two things, but I'm a bull on stocks. So anyway, get this book. I'll put a link in the show notes. Anything by my man Henry Hazlitt, critical to get. All right, we'll see you.